Well, hello and a very warm welcome to this Scope Ratings webinar on Outlook for Covered Bonds. My name is Keith Mullin, and it's my absolute pleasure to be hosting the session today. I'm equally delighted to be joined today by Carlo Fuchs, Head of Covered Bonds at Scope Ratings, and Matthias Pleissner, a Director in the Covered Bonds team. In a moment, Carlo and Matthias will take you through a short presentation, and after that, we'll be delighted to answer your questions. Now, you will find a questions function on the right-hand side, so please feel free as Carlo and Matthias go along to type your questions in, and we'll do our very best to answer them. If for any reason we're not able to answer the question because of lack of available data, or we can't answer immediately, we will circle back to you one-on-one and follow up. Now, of course, it's been a very, very busy period in the covered bond market since the end of the summer. And so I know Carlo and Matthias have been extremely busy. So, gentlemen, it's really good to see you. Thanks so much for being with us today. So I'm going to hand the floor over now to Carlo, who will kick off the presentation. Carlo, the floor is yours.
Thanks, Keith, for introducing us. So thanks, everybody, for dialing and clicking in. And we're trying to give you a bit of the scope view on what's currently happening and what we believe is potentially going to happen going forward, even though, of course, the typical disclaimer, this is not yet the full year outlook. This is looking at what's currently happening. So our full year outlook is coming later. Hope you didn't expect this already to be the first one of the flurry of outlooks that are going to be around. Anyhow, I think for a change, actually, I think the covered bond market looks a bit different today than it looked a couple of months ago, because we were in a very downbeat mode when it comes to actually anything that has come to the market when it comes to public placed covered bonds. And then this clearly we've seen quite a changed sentiment. Still, I think we need to be conscious, and you see here that slide that I borrowed from some other colleagues here. You see that the pace of the covered bond issuance this year clearly has been well below what we've seen in the last years. And the last years in themselves hadn't been too great either. So clearly this change that happened since the market reopened in late August really is something that is positive. And indeed, you see, despite actually being much further down at the first half of the after the first half of the year, actually issuance has quite strongly picked up. And actually, when you compare simply the time since the market reopened till now, we're seeing about 30 billion. This number is already a bit old, looking at the issuance that took place the last couple of days. So we are actually even more than 10 billion and now more of stronger issuance that we've seen in 2020. So is it actually sufficient to really help us actually to cross the 2020 trajectory? We actually don't believe so, because unfortunately, I think we're now in the midst of October. A lot of the issuers are already issuing the quiet period before they are publishing quarter numbers. And therefore, I think really the flurry of new issuance has been or will subside again. And I think it's fair to assume that still at the end of the year, we're going to see we're going to still end up below the last year. And I think we're coming to that in a second. I think however, and that is what we believe is one of the major change. I think what clearly has changed between the last quarter and this quarter is really that the yield environment has changed quite significantly. We've seen a strong upbeat in inflation. And as a result, also the shape of the yield curve actually has changed quite significantly. And you might recall that even though negative interest rates have now been the norm for quite a long time already, and that basically, it's almost impossible. It has been almost impossible to get a positive yield in the covered bond market for durations below 10 years. I think this has slightly changed. In particular, when you look at the last year, when you look at the red line that you see here, basically at the end of the last year, basically it was almost impossible really to get a positive yield in covered bond land. Here we're showing the AAA government bonds, but please always be aware that just it's a parallel shift for covered bonds, and that this is not that significant. Basically, you had to take ultra long duration, and you had to take credit risk really to get something on if you want to get a positive yield on a cover bond. And clearly, this just continued. That anything that has a cover bond label basically was nothing that traditional investors would look at. However, I think by now we need to be conscious that investors actually in the cover bond space, what are they? You have the central banks that are taking the largest share, and they're pretty insensitive against the shape of the yield curve because they have a mandate. You have the bank treasuries that anyhow, regardless of the tenor, they swap it back to floating, and therefore only look at the spread, and they have to buy it. And of course, then there are some others that are still left around. But the traditional long-term investors, insurance companies, actually you can't get them on the board if you can only offer something that is negative yielding, even more so negative yielding for more than 10 years. I think that's nothing that is very appealing. And that's why you have to look elsewhere, which of course was also one of the intentions of the ECB when they started the whole of that. But what's positive, inflation meant that actually today, and when you're comparing the dotted green line against the thorough green line, actually within 1 quarter, basically, you now see that you can issue in a positive territory when you offer tenors like 7 years. Actually, recently, they even have shortened a bit further. So I think that's really something that at least there's some light at the end of the tunnel. We said we don't expect actually the flurry of new issuance that we saw now since September is going to continue. And that simply is because we don't believe that actually inflation is going to stay as it is. Our house view is that it's going to be transitionary and it's eventually going to revert back. And that is actually where a material shift clearly hinges on whatever the ECB policy is going to evolve into, and that's going to be simply remaining a drag on the market. And looking at the figures, basically most observers actually don't expect anything to change until kind of Q3 2022. So, and if you ask the market actually when do they believe that actually central bank rates might get back in the positive, I think we're still talking something about 24 and above. So clearly it's going to remain a dire period. So we have to see actually when are we going to see a real pickup. And I think we're going to come to that later in a second, because there are going to be some drivers that might actually help us. But again, most of them will hinge on whatever the ECB does. And the ECB, the elephant in the room, they are really continuing to increase the holdings. And I think it's quite staggering when you look at the bars. The bars actually show the ECB statistics out there, and basically what's the use of collateral. And I only took here the covered bond numbers. And when the ECB says basically currently 717 billion of covered bonds are currently in their pockets for the various monetary policy measures that they're entertaining. Let it be the purchase programs on the covered bond side, let it be the TLTRO. And clearly, this is actually where most of the distortion was coming from, the TLTRO, because clearly the cover bonds have remained and are still one of the preferred collateral types for banks that are using the TLTRO. And that's clearly when you see here the large uptick here in the holdings. That was here when the fourth iteration of the TLTRO kicked in, and really at that time, really massive amounts of retained cover bonds were issued. And what it actually means, and that's here the graph on the back. That's actually the share of ECB holdings in relation to the total benchmark universe that is out there. And I think it's quite striking that by now, actually, the ECB holds 45% of that market. And I think that's clearly an extreme distortion. And that's also why the ECB is really the actor that is going to drive whatever is going to happen and needs to be carefully managed. And actually, when we talk about the issue of retained cover bonds, that's actually something where also here from our side, from the credit rating side, I think we are clearly watching what's happening there. Because what happens when you want to use cover bonds as collateral for retained issues? What are you doing? You're trying to optimize actually the haircuts that you're getting. The more bang for the buck that you're getting, the better. And that's why very often cover bonds were issued, unlike normal cover bonds, not in fixed but floating format. They were issued in short maturities, and they're quite sizable. Yeah, and that's why it becomes decisive for us, because when you look at the risk that we see in cover bonds, clearly because of the protection that is available via the various legislations, actually credit risk is not the main driver. We always reiterate that's really the asset and liability mismatch risk that's the most prominent driver for what's needed to actually support a high rating, and that's actually the over-collateralization. And that's where the issue of retained cover bonds comes in, because trying actually to get what's the share of cover bonds, there is no flag or whatsoever that you can use to identify a retained cover bond. There is no way to actually see how how they do impact the asset liability profile of a cover bond program, and thus its risk profile. And I think where the risk is that once the TLTRO eventually is going to change, and that's actually the kind of hope that we have, because once this becomes less prominent, banks will have to see that they need to replace the retained cover bonds they've used for TLTRO for public issued cover bonds. And that is where we clearly have to see what's happening in 2022. Why? Because from a regulatory perspective, the cover bond that were used here for the TLTRO most likely will fall, not most likely, they will fall out of the recognition for NSRO, NFSR purposes. So for the net stable funding ratio calculation purposes, once they kick into a 1-year residual maturity. So then the TLTRO no longer can be accounted for. And that's when the banks have to see how can we manage our regulatory ratios, the mid to long-term funding ratio. And that's where we're going to see what's going to happen with retained cover bonds. And here I think I just really wanted to reiterate, on the market risk side, that's actually where the cover bond harmonization brought less what is expected. When we initially saw the EBA proposals, we were quite pleased because they had much stronger stance on anything related to market risk as well as asset liability mismatch risk. Most of that got dropped. So there are really limited restrictions to unwind then here the retained cover bonds. And actually it's also quite easy because unlike a bond that is issued in the market and, where you might need to do a reoffer or where you need to offer also some eventually spread pickup, if you repurchase here, you can simply net it out and take it out. And that's where we actually would hope that there will be more disclosures on actually retained cover bonds. It's already out there. That's what the cover bond harmonization actually brought forward, that more and more issuers are actually here providing cash flows both on actually a scheduled maturity basis, but also on a extended maturity basis to cover for the risk of soft bullets. Such information is not available for what happens for retained cover bonds. And as we are talking here, not about the gun concern situation where actually the soft bullet view is relevant, but actually the going concern. Here, we believe that actually active investors should have a vested interest that they also get here some information. But there's always the hesitancy by the issuers. And I think here, active investors that want to guard really the credit quality of their cover bonds, they really should push for more transparency. And actually here, the $1 million question today is, who is the largest investor all issuers would listen into if asked? It has 3 letters. So I guess this investor that sits here in Frankfurt and is actually the most relevant market player for covered bonds these days, if they would come forward and ask for this information, I guess there would be very little issuers that wouldn't oblige to that. And actually, they've shown already in the past that they can really educate the market or help them to progress, because whereas in the past you always had those laggards that actually didn't provide information on their cover bonds only very late in the quarter, this actually has shifted quite significantly. And this is actually because of some of the rules that the ECB had put out. They put out that if you want to retain your eligibility for cover bond repo operations, then you make sure that the information is published by your friendly rating agency within 8 weeks. And if you don't do so, then actually you won't get that recognition. Also, they actually obliged basically that the issuers more or less follow the industry standard, the ECBC template. And I think this has been quite beneficial in the market. And I guess that's something we actually would hope for, that here the risk management side of the ECB really would try to ensure that there is no risk coming in, and information like what's the share of retained covered bonds, in what pace they are going to get unwound. I think that might be something that really from a credit perspective would be extremely helpful if this would come forward. And this is actually from an outlook, I think already a lot of that, but there's actually more out there. Cover bonds are collateralized bonds, and they are collateralized with mortgages. And that's where Matthias is going to show you a bit more and give you some insight on what's happening on that front and what we expect.
Nice turnaround. Thank you, Carlo. Actually, I remember that we somewhere mid-July were publishing a report with the title European House Prices Hit Highest Growth Rate in 14 Years. And actually, now, just a couple of months later, the report could basically still carry the same title, right? Because still we are in absolutely elevated levels. It's again 2.9 on average, which is the highest since 2007. And that's a quarterly figure, right? That's not an annualized growth. Since the start of the pandemic, early 2019, the average quarterly growth is now 1.9%. And if we compare this towards the average growth during the last decade, which was 1.1% only, there is a huge discrepancy between the two, right? If we just, again, start from the pandemic and look how this compares to what we have seen as an average during the last decade, we are almost 7% of price growth above the trend of the last decade on a cumulative basis since early 2019. And even that, to be frank, the last decade had already shown some elevated and strong increases of house prices already. I think the main drivers of this are relatively clear to most of you. And first, of course, the unchanged monetary policy continues to still fuel house prices across Europe. It has never been cheaper to borrow money. Furthermore, savings are higher than ever because options for consumptions during the pandemic were basically quite limited, and to some extent they still are. While at the same time, deposits may bear negative rates. Real estate investments may consequently be one of the only real alternatives, right? And these effects clearly contributed to the ongoing and increasing demand into real estate, but at the same time, this demand is not really satisfied by proper supply. So what we do see in most European markets is a clear supply-demand gap. It's clearly not about speculative building activity or alarming credit growth, something we have seen in earlier crises. but it's still concerning to some extent, given this growth is far above GDP, it's far above inflation or consumer prices during the same time. However, and this is clearly something which is new in this debate, inflation came back. So we feel it by looking into our electricity bills, we feel it at the petrol station, but it's also affecting the current construction sites, right, and the respective costs. And this consequently also matters for house prices as well. In the second quarter this year, the European construction price indices increased by 4.7% on an annual basis. And this is the strongest price appreciation since 2008. This, of course, was mostly driven by the problems in the global supply chain and the lockdowns we observed during the pandemic. And also the Ever Given blocking the Suez Canal was just basically a drop in the bucket. But what does all of this finally means to house prices? On the one hand, it can, of course, further incentivize households to buy property, driving house prices even further, especially when the alternative is receiving negative interest rates on bank deposits and, of course, a loss of purchasing power. On the other hand, higher inflation, in case the central banks reacts, could ultimately lead to higher mortgage rates as well. And I mean, if mortgage rates goes up, this may also reduce the attractiveness of debt-financed house purchase and as a consequence, house prices. If we then now also look at supply, we at least see that this tries to catch up somewhat with building activity awaking from its deep slumber during the last years. And also, this is something we've seen during the pandemic. Construction wasn't hit that strong as initially expected. So actually, residential construction output in Europe contracted by only 5.1% in 2020, which compares to the earlier expectation of 8.6%. As you can see in the first bullet, I was putting a question mark to the slide. This is because we can't basically tell if those developments we see on the European housing markets during the last decade, especially in the metropolitan areas, are a bubble or not. The growth, and this is something we can say for sure, is not necessarily sustainable if we take the housing market's long-term trends, but also GDP, inflation into account. Also, obviously, affordability becomes more and more under pressure, and again, predominantly in the metropolitan areas. Together with the ultra-low interest rates, there is clearly some risk on the horizon. But finally, I mean, who knows, maybe inflation will soften real estate, real house prices on a medium term. While, and this is something Carlo already has mentioned, Scopes actually expects that the elevated inflation we have just seen is more a transitory effect and not necessarily here to stay. Anyhow, and this is pretty clear, who is now under pressure are those bodies, for instance, banking regulators and the macroprudential authorities that do have to care about financial stability and who are in charge to introduce potential measures to still ensure financial stabilities. And actually, those have raised concerns on house prices even before the dramatic house price growth during the pandemic has shown true, right? So from 2014 to 2018, regulators actually were quite active in trying to calm down markets by introducing certain macroprudential measures. Such measures generally were limiting loan to values, they were limiting debt to income ratios, but also maturities, and introduced minimum amortization. Some of them were hard limits, legal limits, some of them rather guidance or just recommendations. Since 2014, we count 126 of so-called borrower-based actions, that all had the objective to finally soften credit growth and the respective leverage. But since 2019, so the early phase of the pandemic, there had been only 30 actions, of which some even were easing earlier measures given the authorities feared financial disruptions and credit shortage from the pandemic, which, as we all know, did not came true. If you look at this map, a special focus could be placed on the gray points. For instance, Spain, Italy, and Germany, where there have been no macroprudential measures that had been introduced since 2014. While you could clearly argue, well, in Spain or Italy, they're still somewhat recovering from the previous crisis. In Germany, house prices have now been skyrocketing for more than 10 years. However, if we look into the June report from the German Financial Stability Committee, they actually say that there is no acute risks to financial stability from the residential real estate market. And from this, we take that such macroprudential measures, at least in Germany, are rather unlikely. On the other hand, from Austria, we have just heard that they want to make some change in terms of their limits. They have introduced already as recommendations. They're going to change this as legally binding limits, which clearly might have an impact. And those limits might reflect then a maximum loan to value, but also certain elements in regards to minimum amortization. In any case, and as always, it's about the right balance between some of those defensive measures on the one hand, without choking off a targeted mortgage market on the other hand. So obviously, there is some need for affordable housing as well as ESG compliant mortgages, which from our point of view should be treated more carefully in light of any of those potential measures. The next slide is basically not about house prices anymore. This is more about our covered bond portfolio. And this is something I would quickly summarize before I hand over again to Carlo, who's going to talk about the status quo of the covered bond harmonization. So actually, and as of the third quarter 2021, we do rate 40 covered bond programs from 26 issuers in 11 countries, which are all rated AAA and do all have a stable outlook. If you look at the left chart, you see that obviously those countries where we do rate covered bonds that are most resilient are those in Finland, France, Netherlands, Sweden, and Denmark. And this is primarily reflecting that here the average bank ratings within our coverage universe are the highest. And as a consequence of this, those covered bonds have also the highest buffer against the potential downgrade of the issuers. And accordingly, this provides, then some downgrade buffer for those. Also, for those, the ratings are predominantly driven by the fundamental uplift only. And this is basically different to what we see in Norway and Austria. And this is simply because in Norway and Austria, we rate programs of issuers which are rated slightly below those of the other countries. For those in Norway and Austria, we also do take into account the cover pool uplift. And this accounts for roughly 15% of all our rated programs. However, for those still, we reach AAA and stable outlooks simply because the cover pool uplifts still support highest ratings. Finally, most of our ratings are quite resilient to issuer downgrades. As already mentioned, for the 85% cover pool support is only a secondary rating driver, but provides additional rating stability in case the issuer would be downgraded further. With that, Carlo, as mentioned, I would give you the stage again, just to wrap up on where we stand on covered bond harmonization.
Yeah, thanks, Matthias. So yes, really, I think from the cover bond side, whatever's going to happen, I think we're going to be really going into whatever comes from position of strengths. And actually, position of strengths is going to be further strengthened by finally the introduction of the cover bond harmonization. Let's see, because there are still some open spots out there. And actually, given that the first hurdle rate, the 8th of July of this year, has already passed, actually, I would have been much happier if the chart I would show there would actually show you everything in green. Unfortunately, only 5 countries actually have made it. They have only 5 have transpositioned the cover bond directive in time, which means there are still 22 that are outstanding to either fully transpose it or actually finally come out of the hide. I think that's a bit disappointing. Clearly, Corona was not expected, and clearly this is the main excuse why a lot of countries really haven't formally translated the European directive into national law. But actually, I think it's fair from the European Commission to at least consider starting infringement procedures for those that haven't. I think what I think from a rating perspective, I find still a bit unfortunate is that in the course of those updates of the cover bond frameworks that we've seen, actually not all countries have been open and were running consultations, provided the ability to actually comment on those updates. And actually, as mentioned, there are still some that actually haven't actually even proposed a new cover bond law. And I think that's something that is not ideal. Also, I think it's not ideal that even for those that have actually made the first cut, the cover bond framework is not only legislation, it's also the secondary legislation and all the finer details. And if we want to really have a fully functioning capital markets union here in Europe, we clearly need to have similar rules. But I fear that in the end, yes, the main things, the main big points are going to be the same across Europe, but likely we're going to still see subtle details. And unfortunately, those subtle details only will matter at the point in time that it matters most. And it's unfortunate that they are not as public for now as they could be. Still, I think, as Keith mentioned, it's a bit also of an outlook. And oops. And that actually means that what do we expect next year? Clearly, July 8th, 2022 is going to be the main hurdle, because upon then, really the regulatory weightings will depend then on the new requirements. And I think that's why we expect really a rush by year end. Let's not forget, legislation is something that takes time, needs to pass certain processes. And that's clearly what we hope for the next quarter and going into the next year. And clearly, I think one thing I actually hammered a bit on retained cover bonds. At least there's some hope for them, because even though, yes, they could be canceled out quite easily, actually retained cover bonds might actually, for those countries that have made strong use of them and might have more prominent changes. And here we're talking like here Portugal or Spain, even here Italy. We might see those retained cover bonds potentially recycled, because they are issued, they are still grandfathered, and they might be simply put into the public market. Still, I think we're at the end of our short recap, and we are, of course, open for question. And Keith, if you might have a look around whether there's some that actually haven't fallen asleep and actually might even want to know a bit more about covered bonds.
Thank you, Carlo. Thanks, Matthias. I'm sure no one's fallen asleep yet, Carlo. While please, as Carlo mentions, please type any questions you have into the chat facility, and we'll try and answer them. In the meantime, Carlo, let me just come to this business on harmonization that you just talked about at the end. You mentioned that the Commission is considering infringement procedures. How likely, realistic, do you think it is that they'll actually unleash infringement procedures? Because that's quite a serious step.
That's definitely right. I think it's a whip that they're currently using, but it's not going to hurt because still the expectation is that a lot of countries actually are going to come forward, going to show their card by the end of the year, and we all know that actually infringement procedures take actually time to really pass all the internal hurdles at the Commission. So eventually, at the point in time that they come forward, I think what they're trying to address might be addressed. Therefore, I think it's just a gentle nudge that is out there that really you should speed up now. And of course, there's certain self-interest here by the issuers really to get that going. So the Commission is pushing. Issuers will be eager to get that done. So I guess legislators eventually will also cave in.
Yeah. Thanks. Now, earlier in your presentation as well, if I can stay with you for a second, Carlo, you talked about the European Central Bank, and you mentioned that they had actually introduced a bit of discipline into the market. As clearly the market's biggest investor. You also talked a lot about what you think it might do or should do with regard to the transparency around retained issuance. It's another how likely is it question, but from your kind of understanding of the kind of narratives in play in and around the market, do you think it's in the short to medium term we might see any movement on that transparency?
I doubt, actually. Of course, the disclaimer, we don't suggest anything to the ECB. I think that's for sure. They are totally independent and they do what they deem appropriate. It's simply that from a credit perspective, I think, and given the fact that the ECB is not only providing liquidity via the TLTRO, you also have the covered bond purchase programs on which, they sit on more than 300 billion of covered bonds. And therefore, I think they have a vested interest really to make sure that the credit quality remains impeccable. And I think clearly, but this is what every investor has as an interest. But still, as we have seen, sometimes it really takes a nudge for the issuers to really start moving. And there, it doesn't have to be the ECB, but clearly they are the one that are the most relevant investor out there. And we've seen in the past that, they get listened to. We saw the flurry of conditional pass-throughs when, banks had problems to actually come up with sufficient protection for the covered bond programs to support highest ratings. And they started to basically introduce conditional pass-throughs, which again, from a rating perspective, I think is really good because you're eliminating the premier risk in a covered bond, which is the asset liability mismatch risk. Still, it's nothing that the ECB actually liked. And here also, they softly nudged the issuers to avoid them, and they have their toolkit, they have the haircuts, they have their eligibility criteria. So I think they need to protect their investments, and every European, because that's the European Central Bank, that's our central bank, should have a vested interest as well that they protect whatever they're investing in. And therefore, I think, given that nobody expects the ECB to unwind their covered bond holdings from the purchase programs anytime soon, when you ask around 25, 26, nobody knows, but clearly there is no immediate time where you can start, where you think that they start to unwind it. And actually, you have to recall that every maturing covered bonds actually becomes reinvested. So they're sitting for quite a significant time on those covered bonds. And as of now, Matthias highlighted that, we are in the best of the worlds. Covered bonds are currently as well protected as they can be. There's no issues in the housing markets. High house prices mean a lot of buffer against slumps in there. High bank ratings support the cover bonds. Lovely, all good. But cover bonds are a long-term funding instrument, and if you're sitting on them also for a longer time, you need to be conscious on what happens. And that's why I think investors need to be aware that good times can turn. And we don't expect any of those turns to already occur in the short term. But as mentioned, TLTROs are start to run out, or potentially this big here, this TLTRO 4, 1.3 trillion, when they start to unwind, it's going to have market disruptions. And if this gets done quickly, it can have repercussions on the credit quality.
Absolutely. You mentioned you're the best of all worlds. Matthias, I was taken when you were talking about how, excuse me, breaking my own rule. You talked about the house price inflation, and you kind of inferred, you were quite cautious in your comment. You said we're, maybe developing into a bubble, and you kind of inferred that there may be room for macroprudential measures to try and calm the housing market. If I could push you on how concerned you are around house prices and what you think might happen. It's clearly no one knows what might happen, but do you think we're getting to the point where we really need to have some calming measures?
Well, I basically think it's now potentially the best time to introduce additional measures. Even before the pandemic, even before 2019, there had been a lot of noises in the market, concerns related to house prices, and also bubbles were kind of discussed all over. And what happens since the pandemic is basically that house prices even substantially grew above what we have seen before. But at the same time, those macroprudential measures were quite limited. In the contrary, some of those that had been introduced were even relaxing earlier made measures. But honestly, going back to 2019, at the very early phase of the pandemic, who actually really anticipated the effect of the crisis on house prices? Who was expecting what's going to happen? Who thought that prices are increasing during such a crisis? Hardly anybody. And I think that's basically the same position of those bodies discussing those measures, right? They were more cautious not to risk financial stability and cut private funding during a period of potential crisis. Accordingly, they remained likely very silent, relatively silent. But what I would expect now, basically, and what we also to some extent hear within the market, is that they become more active in introducing additional measures, potentially even harsher than they used to be in the past, in order to calm down what we see on house prices, which also, and this is what I try to highlight, is not necessarily sustainable if we look at certain other measures, such as growth of GDP, consumer prices during the same time.
Yeah, it makes sense. I've got one more question. I'm conscious we're running slightly over time, so perhaps we should wrap up in a minute or so. But one final question to you, if I may, Carlo. You talked about the investor breakdown of covered bonds, and there's clearly been a shift away from credit investors towards rates investors, as your central banks and I guess bank treasuries. Given the dynamics we're seeing, the technical dynamics in the yield curve, and the shift back to positive yielding covered bonds further back along the curve, do you think that we might see some re-emergence of credit investor interests, traditional long-term credit investors in covered bonds? Or do you still think that that is a sort of a technical picture is not quite right?
I guess it's going to take a very long time. You know, in order to become again attractive for real long-term investors, I think we need actually not only the break even to zero, we need a higher one. You always need to bear in mind there are capital charges attached, and so really to really make it attractive, you know, you need to have really something more than, you know, close to 1% and to really lure back here those that are in for the long run. I think we have to remain in this situation that basically you see the hoard that you currently have, which is, you know, again, central banks. It's the bank treasuries that make about half of what normally is taken up. Again, for whom? You know, we had this name already. And you have those asset managers that manage, you know, LCR portfolios and the like, again, for whom now actually for the banks, but still in order to meet regulatory requirements. So I think cover bonds, you know, it will take a while to see new themes really to emerge, and new themes, let's see, when we might cover some of them in the outlook. You know, there's always the issue when it comes to reviving Europe, reviving the market, you know, ESNs always pop up, you know, they're basically using the cover bond product setup as a blueprint. You know, let's see what happens on that front. Let's see what happens actually with regard to new markets. Clearly, in benign times, it's much easier to enter them than in difficult times, and that's where potentially more CEE countries might actually open up here for traditional investors. Because again, that was one of the themes in the last year as well, where you saw more CEE countries. And why? Again, they were offering some pickup that you weren't getting actually in any of the traditional cover bond markets. So I'm still positive things will happen, but I guess it's going to be a slow pace until really the market becomes firing out of all cylinders and be back in the shape it was a couple of years ago.
Indeed. Okay, well, why don't we finish on a cautiously positive note then? So I think we should close it there. There are no questions that I can see. Or let me just check before we close. Yeah. Before we do go, I just wanted to thank Carlo and Matthias for their comments. Thank you to you for dialing in, taking the time. You may have seen that also today Scope published the Cover Bonds Quarterly, which, as well as some of the themes that we discussed today, it also has links to related research and also links to recent rating actions and monitoring notes. So it's a great read. So I do draw your attention to it. It's on the website, www.scottratings.com. And any questions, please feel free to circle back to myself, to Carlo, or to Matthias. And so I think that's it. Let's leave it there. Gentlemen, thanks again. And we will see you all next time. Thanks for watching, and goodbye.
Bye-bye.
Goodbye.